Are you sick of paying taxes and won't want to pay anymore? Well, guess what? This is the only video that you need to watch, so listen very clearly. And after watching this video, you're going to learn about how as a real estate investor, you're not going to pay any taxes legally. And if you are, you might need to look into what's going on with your accountant or what's going on with your rental portfolio. I'm Josh Tavares, investor and realtor with the eXp Realty Brokerage. It's so great if you can help us out and hit the like button, hit the subscribe button, and hit the notification bell to get updates on our newly uploaded content. And let's all get started. Here we go. As a real estate investor here in Canada and even in North America, there are different types of expenses. There are current expenses and capital expenses, and we're going to get into this right now. Current expenses are expenses that happen in an ongoing month that don't really provide any value to the property. So it's going to be interest payments, it's going to be maintenance, insurance, property tax, utilities, you name it. They're happening on an ongoing basis and they don't provide any value to the property. Now, a capital expense is something that can provide value to your property. You can use to depreciate the value of it to reduce your taxable income. And it can be things like a brand new roof. It could be a renovation extension. It could be renovating the home and having new stainless steel appliances. It's things as such that provides value to the property that you can depreciate over the long term of the property. With these type of repairs, they're not just repairs like an odd maintenance call where a tenant may have damaged the door and you need to replace the door. That doesn't really provide much value. It's more alongside what's going to increase the value of the property that you can use to depreciate or reduce your taxable income through depreciation on the property. Now, deducting depreciation is a fantastic way to pay no tax at all, and using the depreciation of the property over time. There's going to be wear and tear happening on the maintenance on the property. So it's a great way to go about not paying any taxes. Now, I will say when you're going to go about selling your property, there's going to be capital gains because you're not living at that property, unless you're of course living in one unit and renting out the other. That would be a totally different discussion, and there would be a portion of the home that you can write off for deductions, and the other half you essentially of course couldn't. Now, another expense I forgot to mention through the current expenses could be vehicle costs, so wear and tear and maintenance of your car in the event that you manage the property yourself. Now, for us, we don't deal with any of that, so we don't really have to deduct that. But if you're someone who lives close enough to your property and it makes sense to go about taking care and managing it, then yes, you can write off gas, you can write off wear and tear on your property. So we highly recommend you go about either having a bookkeeper or bookkeeping everything yourself, keeping all your receipts, keeping everything in one place, maybe using apps like Dex where it keeps everything organized. So when it comes to submitting a lot of the documentation and having it in Excel spreadsheet format that you can send to your accountant, it makes things a lot easier. Now, I will say with Dex, it's going to have everything organized, but you're still going to have everything plopped onto an Excel spreadsheet and do that work manually. Whether it's going to be yourself or a bookkeeper, you still need to have that work done, and then you can send it over to your accountant, which in many times is going to be a bookkeeper/accountant. So I highly recommend you have everything organized and detailed, because if not, it's going to be a little bit more stressful as an investor come tax time. Also, many new real estate investors don't understand that a mortgage interest is also deductible, not the principal, the mortgage interest that you're essentially paying the bank because they're making money off you. The money that they're actually making is what you can deduct. So that's really fantastic. If you have a mortgage that let's say is $1,500 and let's say $500 of that is interest, $500 of that you can use towards lowering your taxable income. Now, I will say that with becoming a real estate investor, now we are not tax professionals, we are not accountants, we are not lawyers, but based on our experience, I will have to say that with this type of method, now let's just say you have a lot of expenses to deduct. Let's say you have a property that maybe has very minimal cash flow, even if any. Because you have a lot of expenses, it only helps your taxable income on the property, not personal. So let's say that you have you have your own primary residence, you have your own job 9 to 5, and you have a high income. You can't use your maintenance on your rental properties to bring down your personal income. It's only based on the expenses or the tax that you'd have to pay on that property if it didn't have any expenses, which of course it's a rental property. It's going to have many wear and tear and many different things that you can use to bring down your taxable income on that asset. Like another strategic way that we've gone about investing in real estate while also using it as a way to reduce our taxable income is refinancing our properties and then going about using those funds to purchase other properties. Well, guess what? The refinance amount from other properties that we use to purchase other investment properties, we've been able to use that mortgage or that interest and be able to write that off on that property itself. even though the funds may have came from a primary residence to use to invest into an investment, we've been able to use that mortgage interest and really help out with this rental property. Because guess what? Without that secondary mortgage or that refinance amount, we wouldn't be able to have the rental property. So it's easier to justify come tax time. Another strategy is actually incorporating your rental properties, which allows you to split your income with family members while also having tax benefits as well as liability limitations as well, which actually helps you as an investor versus owning it personally. As an investor, if you personally own a property, and let's say someone slipped and tripped on your property, they could sue you for over $1 million. And if you don't have adequate insurance or whatever the situation may be, they could sue you for everything you have. However, in a corp, they're only able to sue you for whatever the corp has access to and not your personal residence. So let's say you have a property in a corporation and someone trips and falls, they want to sue you for $1 million. They can only go for that home and that asset. They couldn't go for your primary residence, if that makes sense. And once again, we're not accountants, we're not lawyers, we have experience in the real estate investing realm. So if you guys have any questions or concerns, I highly recommend that you speak to a professional accountant, lawyer in your space. As an investor with having your properties in a corporation, whether it's in Canada or the US, there's going to be different types of taxes in terms of the percentages they can take from you. In Canada, they can tax you 50% on your net rental income, and they can also tax you 25% on your rental property capital gains if you decide to sell your property at any point in time. When it comes to incorporating, it really depends what way you want to sway towards. There's no right or wrong answer. It's something that you may want to look into. When you're starting off having a couple properties, you might just be better off having it personally, but as you begin to grow and have multiple properties, have multiple partners, we highly recommend having a corporate structure in place. Now, as a real estate investor, whether it's on the US side with the IRS or the Canada revenue side, you need to know what you can and cannot essentially claim, because you don't want to have too many expenses you're claiming and then you go about being audited and have to pay back a whole lot of money. So you need to understand what you can and cannot go about deducting and work with a professional tax professional. If your property is not cash flowing, there are rental losses that you can go about deducting down the road and using those expenses in other years. But remember, you don't want to cheat the system. If your property is actually cash flowing, but you're putting on paper that it isn't, well, guess what? The government's going to ask for leases. It's going to ask for documentation to prove that if things seem very much out of hand. So whatever you're doing, I highly recommend you working with a professional who does things ethically. And also too, you want to run everything accurate and ethically as well. In the United States, there is a massive tax advantage. It's called the 1031 exchange. This allows an investor to sell a rental property, use those funds to purchase another rental property, deferring having to pay any capital gains, something that in Canada we can't essentially do, but in the United States you can, which is a phenomenal game changer in terms of building and generating long-term wealth. As a real estate investor, it's very important to look into a lot of different things, including your short-term, long-term tax implications, understand depreciation, how you can use this to your benefits, and of course doing things ethically and legally. You don't ever want to get into real estate investing, have the wrong information, leave within 2 years, and have a massive tax burden come capital gains time come the following year when you do your taxes, and then be completely in a bad situation, worse you had essentially imagined, because you had the wrong information. You want to go about speaking with professional individuals, whether it's going to be a mortgage broker, an accountant, a lawyer, a realtor, people who are professional in the space, who are investors, who have the answers to these questions so they can pinpoint the right vision for you. So essentially you'll be able to understand what you can and cannot do, and when the time comes right to go about selling, you'll have the right answers in place so you're making the right decision instead of making something that can hinder you financially in the future. Also, rules when it comes to real estate investing and taxes can change from time to time. Every couple of years, sometimes a new government body comes in and they essentially change things out, making it sometimes less favorable for real estate investors or sometimes more favorable depending on what it is. So we highly recommend always stay on top of what's taking place in the jurisdiction that you're investing in. I hope this video was super helpful, insightful, and gives you all the information that you need to know about not paying any taxes at all as a real estate investor, whether it's in Canada and the US. I'm Josh Tavares, investor and realtor with eXp Realty Brokers. It was so amazing if you can help us out and hit the like button, hit the subscribe button, and hit the notification bell to get updates on our newly uploaded content. If you guys have any question regarding real estate investing, hit in the comment section below. And also, we do have our real estate investing course coming up, so stay tuned for that. So we're looking forward to launch that and have you guys in the loop. Josh Tavares, investor and realtor. Thanks so much. Take care.